Good afternoon, everybody. Welcome to the Bretton Woods Committee 2023 Annual Meeting. I want to thank the IMF and the World Bank for hosting us. And of course, I want to thank all of you for attending both this event and many of you who attended the climate finance session we had yesterday with the IIF and the Paulson Institute, two wonderful groups to partner with. So we have 4 sessions today. So we're going to be very efficient. The first one is we're going to open with the Managing Director, Kristalina Georgieva of the IMF, of course. John Lipsky is going to be in conversation with her. Then we're going to have President David Malpass of the World Bank in conversation with Bill Rhodes. Then we're going to have a session that's going to discuss how we should increase private sector participation in the sovereign debt market. And then we're going to wrap up with a session on a more existential kind of issue, which is what are we going to do about multilateral reform? Is what we have today fit for purpose in terms of the challenges that face us going forward in terms of global public goods like climate? So there's a lot to cover. There are no breaks. There are refreshments outside. So you can take a break, go out and come back quietly, please. Try to keep your phones on silent as we go forward. So I just want to finish up by just saying that there are many significant long-term challenges ahead of us. I got involved with the Bretton Woods Committee about 4 years ago, and I became committed to it because I think multilateral cooperation, coordination is actually absolutely essential, and it's probably in more short supply today than what it was 5 or 10 years ago. So it's more essential than ever. We have the issue of climate change and mobilizing capital to address it. We have the current issue of sovereign debt strains for low-income and emerging market countries. How do we increase the resources to those countries? How do we have a better framework to ensure timely and equitable burden sharing and restructuring? And as part of this, it's really important, what's the role of the IFIs, and do they have the tools and backing so they can successfully do their jobs? So with that in mind, I think we're starting at a really good place with Managing Director Kristalina Georgieva. She's been the Managing Director since 2019, and I think she's done a great job deftly guiding the IMF through a very challenging period. Not just the COVID pandemic, but now, to a large degree, its aftermath. Joining her will be John Lipsky, who's the Vice Chair of the Bretton Woods Committee, and of course, more famously, the former Deputy Managing Director of the IMF. And John's been a key leader of the revitalization of the Bretton Woods Committee over the last few years, and I'm really pleased that I've had the opportunity to work with both him and Bill on the Executive Committee to get us where we are today. So about that banking crisis. So I'm on the UBS Board of Directors. I thought I was done with financial crises. Turned out I wasn't. Thank God, though, I was on the board of UBS as opposed to the other bank. There are some really important lessons of what's been going on. Is that every crisis is different. And I think what we're finding with the technology that we have today, things go much faster than we ever envisioned before. Before, we always were able to get banks to the weekend. With Silicon Valley Bank, we couldn't get to them to the weekend. That was a really novel development. I've been spending a lot of time on this over the last few weeks, not just the UBS piece, but just trying to understand what happened. There's going to be a lot of, I think, reflection by regulators and supervisors about this. Not just in the U.S., where the crisis originated, but also this issue, is bank resolution really feasible? Because the Swiss government made a choice not to take Credit Suisse through the resolution. And that raises a more existential question about whether resolution is really workable for very, very, very large, complex financial organizations. But that's a topic for another day. Today we're going to focus on the IFIs, sovereign debt, and multilateral governance. I have more material.
You can talk about how it went on the board.
No, I can't talk about that.
You'll have all your,
Okay. John?
Thank you very much for
Thank you.
introducing us. That's my chair. Good afternoon, everybody.
Are we ready to go? We've been introduced,
We have been introduced, yes.
but of course, in this house, you need no introduction. And we know that
Neither you, John.
we all know that this is one of the two very busiest points of the year for you. So we are particularly grateful that you are taking the time to be with us. We know it'll be a short time, but it's terrific that you've continued to join the Bretton Woods Committee to discuss the outlook and from the fund's point of view. Today was a big day. The World Economic Outlook was unveiled, and a lot of folks thought that it was quite downbeat, not only in terms of near-term growth forecast, but over the medium term as well. Mm-hmm. Is that the right kind of a response? Was it really a pessimistic document?
Well, first let me say, great to have you in the house rather than on screen. Thank you for coming. I think it is a very objective picture of where we are. It is, in my view, a rather positive picture, because what it says is that we have worried of slipping into recession when inflation hit and interest rates had to fight it. The risk of a slowdown in the economy that could be quite profound was seen as rather significant. 2.8%, this is what we project for this year. That is far from recession. And our assessment is that there is a good chance that this narrow path to avoid even a shallow recession still is likely to be the path policymakers would take. Now, 2.8 is also not that fantastic. So yeah, it's not a story of celebration that we would have liked to have. And there is, above all, that degree of uncertainty that comes from the complicated landscape we all have to walk through. What is in this landscape? You heard me talking about the hills. You climb one, and what do you see? The next one to climb. Mm-hmm. What we have seen is that despite remarkable resilience of labor markets and consumer spending in advanced economies, 90% of them are slowing down this year. Shouldn't surprise us, because we are moving from a period of low interest rates that was quite prolonged, and not that long ago we thought it would last for much longer. On the basis of this projection, banks, non-banking financial institutions have made allocation decisions. Certainly, there are some vulnerabilities that are now being exposed as we move to the period of higher interest rates that are likely to stay higher at least through 2025. So when you have to protect financial stability and build price stability at the same time, that makes the landscape one that is harder to navigate. And then we have the geopolitical fragmentation that is throwing cold water on what is, to begin with, not a very strong growth prospect. So if you objectively look at the picture, we should be more concerned for the second part of our projections of a longer period of around 3% growth. Because what it indicates is that the dynamism that we need in the world economy doesn't seem to be on the horizon. And therefore, many of the problems we have to wrestle with, remember COVID, we still have scarring from COVID to deal with. We have a long-standing problem with lifting up productivity that, among other things, requires more investment in education, skills development, innovation, research. We have a climate crisis to fight and trillions of dollars that are necessary to fight it. And we have to figure out how to deal with the world in which what has served us so well for decades, an integrated global economy, is less so. And that is the challenge we are putting to the reader, and I can see why the reader can get slightly confused, which we say, it was worse, it has gotten a little better, but not yet good enough.
And does the fund, your colleagues and yourself, see some specific actions that can be taken in each of these areas that is practical and feasible?
Yeah, we certainly do. The first, what I'm going to say is so textbook, I'm almost embarrassed, but hey, I'm a professor from the past. I wrote the first microeconomics and macroeconomics textbook in Bulgaria. Number one, fundamentals. Countries have to remember the value of structural reforms and building strong fundamentals and be much more aggressive pursuing that. It has become, for a variety of reasons, harder, not easier, to pursue structural reforms. And yet, this is what gives the economy a natural boost. Second, public investment has to go where the probability of lifting competitiveness and enhancing the ability to improve productivity, where the chance to do that is largest. And three, yes, we are moving to a world where security of supplies matters a lot from national security standpoint, from economic security standpoint. But it need not be destroying completely the benefits of trade, division of labor, and in particular, it is so important for smaller open economies that we don't chop the links that have made the world more resilient and more prosperous over the last decades. I have a particularly deep regret that the war in Ukraine is still going on. It is not only a tragedy for people who die for no good reason. Tell me what is the good reason of this. But it takes away attention from the world concentrating on other things that matter more. It sucks away financial resources, and it makes the peace dividend a story of the past. Nobody can take any more peace for granted. So what happens? Defense expenditures are going up, and I understand why they're going up, but there is opportunity cost to it. So when we talk to policymakers, we concentrate on 3 slides, John. The first one is the most immediate foundation for growth, price stability, financial stability. And there is work to be done there. It's not easy, and it has to be done with vigilance and agility. The second one is improving the prospects for medium-term growth. Yes. And I talked about that a bit. And the third one is one that at the fund we care very deeply about. Remember that there are vulnerable countries, primarily low-income countries, that simply cannot overcome these challenges left on their own. They need help with debt. They need help with concessional finance. They need help with creating opportunities for growth. When you look back, what gave us the 3.8% global average growth in the last decades? It was economies like China, Korea, the up-and-coming, the Asian tigers, some of the Eastern European economies. Now they are naturally slowing down, but in a world of vibrancy, there should be other countries coming up. We don't see that so much. We see it in India, but a little bit in the Gulf, but not really as a clear wave of lifting up countries so we can lift up the world economy. And for this solidarity, being truly mindful of the fate in these countries is so critical. David Malpass is going to come after me. David is going to talk more about it. But if I look at the last 3 years, what gives me tremendous sense of regret is after decades of poverty going down and hunger going down, they're now going up again. Terrible for people that suffer, terrible for all of us because it undermines global security. So going back to the senseless war, we have so many problems that actually we have to solve. They're there. Why on earth are adding more to them? Why man-made problems have to be sucking away from attention? And where are the women to solve them?
I couldn't agree more. What are we going to do to make that happen?
On a very serious note, yeah. I think that we are incredibly creative, so capable to achieve things that once were unthinkable. And I, for one, want us to be uplifted by that capability and reinforce that sense that we actually can solve even the toughest problems. And this is what we want to inject in the discussions of our meetings here. We actually, if you look back, pick up one data point, and that was the beginning of COVID. Remember when COVID hit, how horrible it was. Completely in the fog. We have no idea what is going to happen in a month or two. Our first projections were for global depression, that the world economy would shrink by around 10%. That didn't happen. Why didn't happen? Because actually we talked with each other, we identified, we diagnosed the problem, then we came up with solutions, then we coordinated action, and we managed to go through. Our scientists invented vaccines, we adopted them, most of us adopted them. And then we actually came on the other side. So we can overcome tremendous challenges, but we can only do it working together on a foundation of trust. And I think if the Bretton Woods Committee can do something for us, is to please always remind us why we exist, to solve problems for the benefit of humanity.
indeed. Now, in the next few days, you're going to have the G7 finance ministers, central bankers meeting. You're going to have the G20 meeting. These are all partial and voluntary organizations. And then comes the IMFC, a representative of a true multilateral group of the fund's 190 member countries. You'll be presenting your global policy agenda, a document, by the way, that I think is due out Thursday and is one of, I think, one of my favorites to find out what the fund really thinks is important and what the fund wants to do. I don't know if it's asking too much. What are the fund's actions that you're going to propose to the IMFC and expect to see supported?
We very much in line of what I have been talking, because obviously we build the global policy agenda on the analysis our teams offer and the discussions we have with the membership. I want to stress 4 things that I expect to see getting support from the membership, and I would list them not in the order of significance, but more in the order of probability we would get it done, and done fairly quickly. First, we are going to present our views around policy priorities and how bilateral and multilateral surveillance can enhance the capabilities of policymakers to make choices in this more complicated, more complex environment. Second, we will present our trend in deploying lending, and then what we see as likely directions over the next years. We have just 10 days ago hit the highest lending from the IMF in our history. We are about close to $300 billion. We still have ample space to lend. And I hear some saying, oh, why don't you lend more and more and more? I think this is very irresponsible. We lend when countries need to borrow. And in this last years, it was primarily medium and small countries, medium-sized small countries that have been most severely impacted. But the value of the fund, our lending capacity, matters when it is ample. Because should there be a shock that pushes systemically significant large economies into a need to borrow from the fund, we better have all the money to buffer. So what we would be talking about is our projections for how we are going to be responding to what we expect likely to be, I'm sorry, still some strong demand from primarily mid-sized small economies. And here is the third ask we are going to have. Our low-income countries find themselves in a particularly troubled water. Their fiscal space practically collapsed. Their financial needs are significant. They came to the fund with very high demand already, 4 times the average we had before COVID. In fact, the first year of COVID, we provided 16 times more lending to sub-Saharan Africa than we have done in years before. The combined impact of higher demand for our concessional financing and higher interest rates, that means it is more expensive to provide that concessionality, means that we are so depleted in our funding that when we increased access levels for GRA resources for our general allocation, we could not increase access levels for PRGT countries, for low-income countries. So just think of the unfairness of that. Countries that have small quotas and low access to begin with have to be kept at the lower access levels despite their enormous financial pressures. So we are asking for more ambition to raise subsidy resources so we can again rectify that unevenness. Last, we are asking the membership to be decisive in completing the 16th quarter review. We are asking for two very important things. One, the fund is a quota-based institution. Over time, the share of quotas has been eroded. Now we are more bilateral and multilateral borrowing resources institution. I have nothing against bilateral, multilateral borrowing arrangements, but they're not the same as your permanent, reliable quota resources. And for an institution that is at the center of the global financial safety net, that matters. Two, we have to see how in this very charged geopolitical environment, we can continue to show that the fund evolves with times. And so that is going to be a very, very important discussion for us. We have already made that an action, but we are going to ask for sort of ascertaining the direction to travel on that. It has been painful to watch how countries under tremendous burden of debt cannot benefit from the fund because their debt is not sustainable. We reached an agreement with Zambia. We can't move on this agreement because Zambia's debt is not sustainable. We have an agreement with Sri Lanka, staff level agreement. It takes months to get the creditors to agree to restructure Sri Lanka's debt so we can help Sri Lanka. We have created a new platform to accelerate action on debt resolution, the Global Sovereign Debt Roundtable. I'm so far optimistic, I hope to remain optimistic after tomorrow, this is when we are meeting, yes, that this can be finally the place where we bring traditional new creditors, private, public, and the debtors, and we identify what does it mean to have an effective debt resolution mechanism, so we can do faster what we need to do. Plenty of work ahead of us. Yes. Oh, and of course the RST.
Yes.
How can I?
Don't worry, I was going to.
You covered it. So
I was going to ask. Yeah. So the issue is, is the fund going to get sufficient support?
So that's a very interesting question. When we created the RST, we genuinely had no idea would there be demand for it or not. Mm-hmm. I'm sure you have heard stigma. You say IMF, and countries say, well, if I'm not desperate, thank you, but no thank you. What came to be is actually a fantastic success story. The RST, because of the terms, it is concessional longer term, but also because it is not associated with countries' poor management, but with the climate crisis that is exogenous to them, is very well received by our members. We already have 5 programs in place. We design it with the pilot phase because we have to figure out how we do it well. And we have 44 countries expressing interest. To answer your question, we thought that with 40 billion, which is what we now have committed, we are done for a long time. Well, yes, we can cover the demand that is there, but it means that we cannot, if you learn that we have to do scaled-up action, we cannot, and we may have to ration what we provide. So we will have to roll our sleeves, go on the road, fundraise some more. Good news, France that started the ball rolling with committing 20% of their SDRs, now said, oops, you need more. They went up to 30, and I expect that others would follow. So we should be victorious in this effort.
Very good. So that would be very important. How hopeful are you for progress through this debt roundtable?
You know,
Is it going to be a long process?
it is going to take some time. What we have is a very complicated creditor landscape, and we have been a bit slow to recognize that these people need to sit around the same table and they need to talk turkey to each other, because what we saw so far is people actually hiding behind each other. So private sector hides behind China, China hides behind the private sector. Well, we cannot make progress because the other guy. Now the other guy is right there. So we would do everything we can to excite creditors and debtors for solutions and relentlessly communicate it is in everybody's interest. It's in the interest of the debtors. It is in the interest of the creditors. Early resolution may bring a country faster on its feet. And then if we build upside clauses in that resolution, if the country does better, you as a creditor do better. So we want to see a pragmatic approach. So far, everybody's participating constructively. We had a prep meeting, a deputy level meeting, went very well. We agreed on 3 objectives for tomorrow. I hope we would come out of it check, check, check. One falls on us to provide earlier information on debt sustainability analysis so creditors can prepare for negotiations on that basis early. We are also asking the World Bank to show how they can be net positive provider of financing at concessional terms so they can add more value to this debt restructuring process. And we are asking the creditors to have a clear pathway to commonality of treatment so they can be more confident that they're all put in the same basket, in the same place. It would take time. I have no illusion about it. We want to complement this with asking for progress on specific country cases. Ghana, Zambia, Ethiopia, Sri Lanka. Let's show that we can resolve these cases. And I can tell you, I would not shy away from screaming from the top of a hill to the creditors, please do your job. Do not suffocate economies at the time when we need each and every one of them to breathe.
Absolutely. So the fund is showing leadership in support for its poorest members in this difficult time, showing leadership in debt restructuring where we had a system that has run aground and need to improve. And a third area that I think is particularly notable, of course, is back in, dare I say it, my era, when we talked about climate finance. The issue seemed, in the future, certainly important, but not today.
Yep.
Today, it's important, and the fund is showing leadership. Do you expect support at the level of the IMFC and the membership in general for the fund being active in a leadership position?
Yes, I do. And we actually have a board-approved climate strategy, a board-approved resilience sustainability trust. Yes, there is also skepticism. Is this your alley? And we do need to continue to relentlessly explain. Yes, it is. Climate shocks are macro-critical. They undermine macroeconomic and financial stability. They challenge our growth trajectory. They are a source of inequality and poverty. With the same token, climate action creates new opportunities for growth and for jobs. We stay strictly in our lane. What is our lane? Fiscal policy. How do you deal with incentives for decarbonization, tax, trade, regulatory compliance? How do you improve spending? We have a product called Public Investment Management Assessment. We now have a C in front of it, Climate Public Investment Management Assessment. This is something we know how to do. Secondly, in monetary policy, how can financial institutions be better prepared to assess portfolio medium long term so they can factor in climate-related risks? Third, data. Integrate climate data in macroeconomic data so policymakers can make better decisions. And fourth, policy, and this fourth is probably the most important, policy environment that is conducive for private investment. We know how to do that. The extra element is do it so countries can attract private capital for decarbonization and resilience to climate shocks. Straight in our lane.
Terrific. I'm afraid our time is up, but I think what we've seen is a clear demonstration. At times of challenge, times of contention, multilateral institutions are irreplaceable, need to be supported, and need to be active. And I think the audience will join me in thanking you for joining us today and for your leadership, and good luck.
Thank you. Thank you very much, John.
Thanks.
The only thing, I see you very well. I don't see the audience very well, but thank you, audience.
Thank you.
Thank you.